To crowdfund a real estate deal requires a marketplace where sponsors seeking capital can meet investors looking for deals. One of the largest and most successful yet of these online platforms is RealtyShares, and Nav Athwal, its founder and CEO, is my guest today. Welcome to the National Real Estate Forum podcast, episode 202. Thank you for joining me today. I'm Dr. Adam Gower, and this is the Crowdfund Project at nreforum.org, where developers, investors, and industry leaders share insights that you can use to raise capital and invest in crowd-funded real estate deals. This is how crowdfunding a real estate deal works. RealtyShares is an online marketplace. Think eBay for real estate. Think eBay for real estate, where developers and investors can meet and transact. Developers, also known as sponsors or issuers, who are seeking money for their deals, either debt or equity, apply to RealtyShares to list their deals online. If RealtyShares accepts them, the deal is put on the platform together with a detailed package of background due diligence information for investors to review. As an investor, you can invest in deals on RealtyShares that previously you may never have had access to. You can invest smaller amounts of money than has been possible before, and so you can diversify across a range of deals, reducing risk. None of this was possible before the Jobs Act of 2012. Before that, sponsors had to have a pre-existing relationship with an investor before approaching them to solicit an investment. But now, all this can be done online and is open to everyone, including you, and covering these changes in more depth than any other place on the web today, so that you can become an expert in raising money for and investing in crowd-funded real estate. To find out more, contact me at the nationalrealestateforum.org website, nreforum.org/primer, and I will send you a free overview of what crowdfunding real estate is. In it, I have included a detailed summary of the various regulations that have enabled online real estate deal marketplaces like RealtyShares and what it means for you raising money and investing in crowdfunded deals. That's nreforum.org/primer for your summary of real estate crowdfunding, absolutely free. Nav Athwal is the powerhouse entrepreneur behind RealtyShares, and I'm delighted to have him here as my guest today. RealtyShares is venture capital backed, and with over $500 million already invested through the platform across over 1,000 projects, it is hard to believe that they were only formed in 2013. Nav has been a real estate broker and developer, has practiced law as a real estate and land use attorney, lectures at the University of Berkeley Haas School of Business on real estate law and investment, and is founder and CEO of RealtyShares.
You know, no matter where you go, real estate works the same. So even if you're in the tech epicenter of the world, which is San Francisco and Silicon Valley, the real estate industry, you know, you can put that industry in San Francisco and Texas and Florida and New York, it's going to operate very similarly. So I think there's a lot of tech innovation potential within the industry, no matter where you're located.
Well, I completely agree with you. So tell me something, if you will, then, about how technology has led to the development of and rise of crowdfunding, and what is crowdfunding exactly?
Sure. So, I think first and foremost, I think crowdfunding is sort of a misnomer. I think it's a great way to generally describe what we do, which is we allow investors to pool money, with other investors that are interested in putting that capital to work into real estate assets. And when you pool that capital and take small amounts from each investor, 5, 10, 15K, which is one of the values we provide, that capital can then be put to work in a group method and take down larger assets. So that's really what, using crowdfunding to describe the concept of pooling money is really how these platforms have evolved. But RealtyShares specifically is geared towards is geared towards high net worth investors and institutions. We consider ourselves a private technology-enabled marketplace and almost like a wealth management platform where we allow investors to put money to work into strong and high-quality real estate assets around the country. So just wanted to clarify that piece, that we're not really true crowdfunding in that we're not allowing non-accredited retail investors, mom and pops, to participate today. It's really centered around high net worth and institutional investors. But going back to your question around, what is crowdfunding and how it's changed, the concept of pooling capital and purchasing assets through like a syndicate vehicle, we really haven't reinvented the wheel here. We haven't changed how real estate deals are structured, how LP capital and GP capital is structured via an LLC or LP agreement. All we've changed is the medium in which that capital uses to access deal flow and put that deal flow. And that medium that we've created is the web, is the internet, and creating a much broader potential access point by leveraging technology, by leveraging the internet, and giving investors that historically may have had no access to real estate or limited access to a much broader set of deals located across different markets, different product types, different operators. So really what we've done is take an old analog access point and turn it into a digital access point and just increase the potential on both sides of the marketplace, meaning both for investors to deploy capital across a broad, diversified set of deals, as well as developers to raise capital at record speed through a network of investors they otherwise would not have had access to. So really that's what the technology pieces allowed us to do, but we're not reinventing the wheel, and we're not changing the structures that are tried and true and have worked for real estate over the last century. So that's really what's exciting.
Okay, so the way it might have worked before then is that you might, if you'd wanted to make an investment in real estate but were hands-off, right, you were wanting to make a passive investment, there may have been, I can think of two possible avenues for that. Either you knew somebody that was doing a deal and they would ask you to make an investment, what they call country club finance, if you like. Exactly. Or you might have gone to a local mortgage guy who was out there raising capital for individual deals. But
exactly.
You've basically taken that and put it on the web, and therefore have these huge economies of scale and much broader reach and efficiency of reach as well, presumably.
That's exactly, you've summed it up really eloquently, in that before you were if you were an investor, you go to a developer in your market doing a country club financing, and you're putting $100,000 to work into a single asset, single market, single operator, a lot of that is looking for financing for a deal. And with RealtyShares, you're able to take that same $100,000 or $150,000, and with our minimums being as little as $5,000, put it across a much broader, diversified pool of assets with different operators and geographies. Real estate is a very hyper-local asset historically, but using RealtyShares, you can get access to developers that are not located in your market. And if you're in California and you think Texas is the next up-and-coming market, you can actually get exposure to that market and sub-market through RealtyShares. So we've not only reduced the minimums, but we've created much broader access, more diversification potential, and the entire transaction process from signing legal documents to transferring funds to getting distributions on a post-close basis. It's completely digital and streamlined. So we've really changed the way access and transactions are done, but we haven't changed the things that work in real estate, the structures that work in real estate. Although I will say one thing that is a little unfortunate, actions are done, but we haven't changed the things that work in real estate, the structures that work in real estate. Although I will say one thing that is a little unfortunate in the real estate asset class is there's very little transparency. So if you're an investor investing in a country club deal and developers charging certain fees to that deal, you don't know if you're getting a good deal, a bad deal, what's market, what's not market. The other thing we're proud about RealtyShares is we've standardized a lot of that. We've standardized what fees sponsors can charge, and we've transparently disclosed those fees and structures to investors. So when they're comparing 2 deals or 3 deals, they are doing an apples-to-apples comparison, and they know what is market and what is not. So I think that's another exciting part of our marketplace, is the transparency and the trust we're creating within our investor base.
So let's talk about from the investment perspective, because you have 2 constituencies. There's the investors, and there are what are called the sponsors, the developers, right? The people that need the money.
Exactly.
So let's on your website. Presumably they're on your website, and I can take a look once I'm qualified and decide what deals I want to invest in.
what sits behind those deals?
Sure. So in terms of sourcing and how we get deal flow, so we have an online digital application process that developers go through to, request financing. And we provide, one of the unique elements of RealtyShares is we can provide debt or equity. So we actually are very unique in that respect, depending on the needs of the developer. So you fill out an online application. It takes all but a few minutes to complete. And the way you find out about RealtyShares or that application is through a few different means. One is, we do digital marketing. We have a performance marketing team, and you can find our ads on Google and Facebook and LinkedIn. And so we just have web presence through our marketing team. We also have forged some pretty high-powered partnerships. We have a partnership with CBRE. We're in talks with a few other major brokerages. And BRE, we're in talks with a few other major brokerages and partnering with them and getting deal flow through that method. And then we finally also have a business development team, and that team's focus is going to conferences and meeting sponsors in their local market to tell them more about what RealtyShares is, what we do, how we can add value to them in terms of capital raising potential. And so that's how they find out about us. And when they find out about us, they come to the website, www.realtyshares.com, fill out a very quick application, and that application asks them information about their deal, about their track record, about their financial strength, et cetera. And we really use that to pre-qualify or reject developers that aren't a fit. And once we've pre-qualified that developer, meaning we think they could be a fit and they are eligible for financing, we put them through a sort of a 20-point underwriting system where we collect data on the deal, a financial model, an appraisal if that's applicable, a system where we collect data on the deal, a financial model, an appraisal if that's applicable, an environmental report. We also will collect data on the sponsor, so how many deals have they done, how well have those deals performed, and we'll vet those that track record. And finally, we'll also get data just on the market, and we usually use our own internal data sources as well as third-party sources to vet the market and the strength of the market. So then we take all that data, we really crunch the deal and numbers and determine if, from a risk-adjusted return perspective, it fits the marketplace and the appetite of the marketplace. And our investors today are pretty yield-oriented, meaning they're not getting yield anywhere else. They're not getting it from the stock market. They're not getting it from the bond market. So they are looking at real estate and RealtyShares as a way to generate yield and get income. And so we typically look for deals that have a cash-on-cash return that is at least 6 to 7% or higher, and an IRR that can be kind of mid-teen. So if the deal and the time, any investor that has an account with us can view it, invest in it, and could monitor how that investment is doing.
And you have an investment committee, do you, that approves these deals before they go up on the platform?
Yeah, we have both an investments team that reviews and vets the deals and structures the deals, as well as a credit team and credit function that ensures the deals meet our credit box and credit policy. So deals, before they're listed on the platform, go through both an underwriting and investments process as well as a credit policy check, and then they're listed on the marketplace for investors to access.
Okay, and you talked about yield. So are these are development deals primarily, are they?
So actually, most of our deals are existing assets. So these are deals that have there's already in place cash flow, or they're fully entitled construction deals. We don't do a lot of development. We actually do no development purely as a function of a few things. We don't do a lot of development. We actually do no development purely as a function of a few things. One is, we feel uncomfortable with development just given where we are in the cycle. So that's one element. Two is, our investors, again, want yield, want cash flow. So doing development deals, and I was a former land use and entitlement attorney, so I know how unpredictable those deals can be. And so the risk of entitlement is something we just don't feel comfortable with, especially with the current base of investors we're working with. So existing assets or fully entitled, fully permitted construction projects is really the bulk of what we do. And we like the fact that we can provide cash flow, because if an investor invests and a month later or a quarter later they get their first distribution directly into their bank account, it really gets them excited, and then they become brand ambassadors for us. They tell their friends and family that they found RealtyShares to access and invest in real estate, and they've gotten their first check, and the yield is something they can't get elsewhere. So that's a part of our branding and marketing strategy as well.
Inevitable downturn, right, that's going to come, but this is a cyclical industry. How do you address that? Do you mitigate that in any way based on knowledge of prior cycles? in terms of how
Absolutely.
you put deals together. So explain that a little to me.
So when we think about our underwriting and that credit function, we are not only evaluating the deal with respect to the current market and how the market, real estate market at a macro level is doing today at the time of underwriting, but also we stress test the deals to determine what would happen if there was a drop in NOI or increase in vacancy and a resulting drop in NOI. So we are stress testing these deals, and we're looking for both sponsor dynamics and deal dynamics that give us comfort that the deal, even if there is a correction, will still perform and still meet debt service coverage and not be in technical default. So a lot of our underwriting and credit policy is geared not only towards what would happen, in today's cycle, but also what could happen if there is a correction. And so we put in risk mitigants into the deals we do to protect against that. Of course, there's no guarantee in any of the deals we make available, and there's obviously deals that won't perform exactly as planned. That's just the nature of investing in real estate, but we do put a lot of mitigants in place to protect against that. And I think a lot of the success of a deal really hinges on the sponsor and their quality and if they've seen a cycle before and how they did in that cycle. And some of the strongest sponsors, they bought at the right time, they successfully executed a strategy, and even though the last downturn was one of the worst in history, they were still able to negotiate with their lenders, avoid default, and eventually, take advantage of the increasing market and the expansionary part of the cycle. So strong operators, deals with inherent risk mitigants, even if there was a drop in NOI, that all helps us. And also not having a development thesis, meaning not doing deals with inherent risk mitigants, even if there was a drop in NOI, that all helps us. And also not having a development thesis, meaning not doing deals with huge entitlement risk that, really just raw land today, also helps protect our investors and the capital that we've invested in case there is a correction.
So then presumably also your investors can assess their own appetite for risk and invest in individual deals that fit that across your platform. They can look at, for example, they may think, Texas is more insulated from any downturn, and if that's their view, then they can orient their investments in that direction.
Yeah, one of the things we really pride ourselves in is being one of the most diverse online marketplaces for real estate investing, meaning we provide debt, equity, commercial, multifamily. So we really provide a breadth of deal flow and options for our investors, because our mission is to not only provide an easy and trusted way to invest in real estate, but also to provide diverse for investors. So, they can pick from a whole host of different risk and return profiles and cap structures, meaning they can be in the debt part of the cap stack, the equity part of the cap stack, and that's really part of our core mission of building a truly diverse marketplace for real estate investing. And our deals also have different hold periods and, again, as I mentioned, different return profiles, and that's really geared towards that diversification goal.
So this might be jumping ahead a little bit, but do you have any portfolio options that are risk profile that you offer clients? So, for example, you might say, well, what's your risk profile, and do you want yield or do you want equity growth, and then offer them a portfolio that you think best fits their requirements, kind of like a mutual fund, for example, might.
Yeah, it's a great question and timely, because as we think about what we're building at RealtyShares management platform, an online wealth management platform or a digital wealth management platform for the private real estate market, and really providing investors options in getting diversified exposure to that asset class. And part of that thesis and mission is really giving them options to invest in different types of vehicles, whether it's direct access to deals, picking the exact asset, the exact zip code, the exact sponsors they want to work with, but also getting sort of almost like a programmatic access to deal flow through a index fund or an LLC fund structure. And so we launched our first inaugural fund early 2016, just as a way for investors to get more diversified access to deals in a more programmatic fashion. And that was more of a broad-based fund, meaning it was really picking. It was almost based on the marketplace and what generally was available on the marketplace, but instead of having to invest in every individual deal, investors invested once in the fund and got exposure to a diverse set of deals. And now we're starting to roll out additional funds that are more specifically focused on certain themes, whether it's income or growth, debt versus equity, and eventually it'll even be product-based, multifamily, or geography-based, meaning West Coast versus East Coast. So our ultimate vision and goal is to provide diversified vehicles for investors to get exposure to different types of investment options, and the fund structure is just one kind of part of that evolution.
Absolutely fascinating. So how long do you think it might take before your platform or platforms like you compete head-on with stocks and bonds and, you know, the usual kinds of ways that people invest?
Yeah, that's our 10-year vision. When you start building a company, initially you're just focused on a very specific problem, and the problem we were trying to solve was access to real estate in a much more efficient investment process and more efficient access to capital. But over time, you start thinking bigger on what this can be, especially as you gain market share. And one of the goals or vision elements of RealtyShares is to build a global stock market for real estate, put real estate as an asset class on even footing with stocks and bonds, so that an investor, whether they're investing directly or through a wealth manager, definitely has real estate as part of their overall investment thesis. And there's not an easy way to do that today. And so, for us, it's a 10-year plan. It could end up being a 20 or 40-year plan. We're committed to that vision. We're committed to bringing more transparency and trust and standardization and liquidity within real estate. And that's what we're really building towards. That's our North Star. And whether that takes 5 years or 10 years or 20 years, that's really what we're marching towards. And picture our vision, when I kind of close my eyes, it's an investor who's sitting down with their wealth manager saying, hey, I want to build an optimized portfolio. This is my risk tolerance. This is my return tolerance. And the investor, the wealth manager, has allocated 50% of their portfolio to stocks and 20% or 25% to bonds, and the other 25% is direct real estate, and it's RealtyShares that is providing that optionality. So that's really what I see in terms of our vision and what we're all trying to execute towards as a company.
Right. So when to happen, you need to have third-party assessment of your performance and credibility, right? So
we need a track record. Yeah.
Well, not just a track record, but like a ratings agency that would look at your performance and rate it. Isn't that? I'm sure I heard somewhere that was real estate funds or maybe REITs are being assessed by the ratings agencies. And maybe that's bleeding over.
It's track record. It's third-party validation. It's a liquidity mechanism via secondary market that doesn't exist today within private real estate. So there's a lot of elements to that. That's why it's such a long-term vision. There's more trust. There's more data. So there's a lot we still have to do to actually bring that level of comparison to other publicly traded securities like stocks and bonds. But third-party validation is just one of those elements, and so that is. That is a component of building that ultimate vision is transparency, third-party validation, liquidity. So there's a lot of work still to be done to get there.
So let's pivot for a moment now to the sponsor side, the developer. Can you give me a little background on what you're looking for and what a developer might look like that would be somebody you would want to back, for example?
Sure. So, we really pride ourselves in being a marketplace serving two customers, and we talked a lot about the investor. The developer is just as important to the marketplace because we want to partner with what we think are the best-in-class operators and sponsors that know their market, have great deal flow access, but just don't have access to efficient capital. So we only select about 10% of deals that come through the marketplace, meaning majority of deals don't make it through our vetting process, and so we want to partner with best-in-class operators. What that means so we want to partner with best-in-class operators. What that means typically is an operator that has done transactions before, so this is not a first-time operator. Either they've done transactions as a principal investor or through a larger shop, and now they're breaking away on their own to develop and buy their own assets, but someone with significant real estate experience. Usually we're looking for 7 years minimum, and a lot of our developers have 20 years of experience. So that's sort of the first prerequisite is a very strong developer and very strong sponsor that's executing the deal. 2 is, again, as I mentioned, our strategy today is non-development existing assets or fully entitled construction projects. So if it's a development deal, automatically it's excluded from what we'll select today. We also are mostly looking at value add and core plus deals because our investors are yield oriented. We do want the potential to generate yield, and so developers working on those types of transactions have a bet in primary markets. So we're not doing a lot of deals in tertiary markets. So we have certain population minimums and employment growth numbers that we're looking at to make sure that the risk of the deal is not so high that there's a potential loss scenario. So I would say at a high level, those are some of the main characteristics. We also 80% of our transactions to date have been in the multifamily sector, and 20% have been across different commercial assets, including hotel, retail, suburban office, industrial, and self-storage. So we are a broad-based investment platform, meaning we do fund different types of projects, and we've done deals in over 39 states, but multifamily tends to be the most frequent deal type that we see on the marketplace. And that's really because of the inherent risk with other commercial assets, given CapEx and TIs, et cetera, just don't make those as attractive to our investor base. And two is the multifamily asset class is also it's the biggest in the commercial sector.
Yeah.
So that just ends up being a broad deal flow. So that's at a high level what we look for. And what we consider ourselves is we're a relationship platform. So we want to work with developers not only on the first deal they do with RealtyShares, but we want to see 5, 10 deals from them. We want them to raise capital through RealtyShares and never have to go back to the old way of raising capital through friends and family, through doing a syndicate, doing a country club deal. We want to become their permanent source of capital for all deals that they're doing, enable them to do more deals, become much more efficient. And so we really pride ourselves in building deep relationships with sponsors and letting them get access to efficient capital and giving exposure to really good deals to our investors as a result.
Have you looked at, you were talking about the different asset classes that you look at, and you mentioned hospitality. Has senior housing crossed your radar yet?
We see senior housing quite a bit, actually. We have not yet done a senior housing transaction, not because I'm not bullish on that transaction, not because I'm not bullish on that market, only because the way those deals function is more like an operating business than a real estate transaction. And I know hospitality has similar characteristics, but but it's been a type of product that we haven't yet got into. But our ultimate goal at RealtyShares is to be a truly diversified marketplace that's providing options in a variety of asset classes. I mean, we've seen mobile home parks, not something we've done yet, as well as senior housing and a lot of other unique types of real estate, ag, for example. So over time, we're going to continue to enhance our ability to do a broader set of deals, but we also today want to focus where we have core strengths as an underwriting team, as a technology team, and senior housing has not yet been part of that strategy, but definitely is an exciting part of the market. Okay,
and when you look at these deals, do you have leverage?
Our credit policies, we typically look at our credit policies once a quarter to see if we want to adjust anything up or down, including leverage. And so it depends on the type of product. The highest leverage limits we have are for multifamily, and typically there we'll let leverage be as high as 75%, in select cases 80% if it's a very strong market. And then for other commercial assets, it's typically a little lower. Usually maxes out around 65 to 70%. So it's market driven, it's product driven. It's also, type of strategy driven. So value add versus core plus, very different leverage levels. So those are just some of the considerations that impact leverage. But I would say generally speaking, on average, our leverage amounts have been around 70%, but we can go as high as 80% for select types of transactions that we feel comfortable with.
And how active is your role in tracking the performance and delivery to pro forma projections of your developers? Once you make the investment, and delivery to pro forma projections of your developers. Once you make the investment,
we have an internal. One critical part of our marketplace is we're not just a way to access deal flow. We are a full cycle investment platform, meaning think of it like E-Trade, right? But for real estate, where you create an account, you invest in different companies, and then you get reporting on how those companies are doing, et cetera, all through that dashboard. It's very similar for RealtyShares. The experience is you sign up, you invest, and then you can monitor the performance of those deals via a dashboard where you have earnings updates, updates on the asset, quarterly, more robust updates directly from the developer. You also have your tax documents and your legal documents all available through that dashboard. So we really pride ourselves in not only providing access to quality deals, but also ongoing asset management, portfolio management services. So we do actively track how deals are performing. We look at how they perform relative to budget and pro forma.
Right.
With a very sticky base of investors that want to use RealtyShares time and time again because they feel like there's a lot of transparency and they could be truly passive and they're going to get all the data directly through the platform. So that is part of our core function. And that data is also very valuable to us because we can see if we did a multifamily deal in Austin, Texas, and we had assumptions around what cap rates would end up doing or what vacancy would end up being, we can take the actual performance, compare it to pro forma, and then use that data, that real-time data, to underwrite future transactions with a more informed eye. So that it all really fits well within our thesis of building, a very efficient way to underwrite and price risk and make that available to investors and create ease of use for investors where it doesn't exist today.
Now, to understand your role just a little bit deeper, do you have, in the unlikely event, let's say, that a sponsor fails to perform, do you have rights to take over a project? Sponsor fails to perform, do you have rights to take over a project like an institutional investor might?
We do. So what we typically do is we build into. So if it's a debt deal, it's very simple. It's a foreclosure process or a deed in lieu. But for equity, we do preferred and common equity. And in preferred, it's debt-like in that triggering events like defaults, et cetera, failure to pay will allow us to take over the actual underlying entity. For common equity, there's typically a manager replacement right. So we do build in a lot of those protections. And then, something we do just to create leverage, given we're a tech company, not a real estate private equity company, is we do use third-party vendors to do a lot of the workout functionality if it ever comes to that, or the foreclosure activity. We try to use third parties to get leverage for the company so we can focus on what our core strengths are and build technology strengths, which is really sourcing deals, underwriting deals, and providing a very efficient marketplace to deploy capital in those deals. So although we have those asset management, portfolio management, servicing capabilities, if there's ever a default, we typically will leverage a third-party vendor to help with that.
And do you use third-party vendors to monitor along the way as well? I think I saw you have 990 active deals. That's a lot of deals to monitor.
Yeah, we do. So we have an internal portfolio management team, but we also do use third parties to do site visits. We also have incorporated drone flyovers, which is pretty exciting into deals we do.
The sponsor's house is there in the backyard having a nap.
Yeah, right. Exactly. There you go.
So when he should be on the job site checking on the plumber.
Exactly, making sure that progress is being made. Technology is amazing, and drones are just a part of that. And we also do that on the front end, and our investors love. Real estate's it's a tangible asset. That's one of the beauties of real estate. That's what I love about real estate. I'm a passionate real estate guy. Is just the tangible nature of that asset. So being able to incorporate the physical elements of real estate into our offerings, so investors, when they're thinking about investing in a deal, can see the surrounding area. They can see that there's a Whole Foods located nearby. There's a park nearby. It gets them really excited, and I think using the drone technology allows us to do that. So it's pretty exciting.
All right, so let me ask you one final question. I know we've got a little limited time, so let me ask you one final question. Sure. And that is, look, the whole platform sounds incredibly compelling, right, from both the sponsor perspective and also from the investor perspective. What is the resistance from both sides that you hear that gives people on both sides of that equation pause for thought? And how do you respond to their resistance? First, what is their resistance?
Yeah, so I think the biggest hurdle is really the education around what this is and how sponsors. What we found is once an investor or sponsor uses RealtyShares once, they're hooked. They want to use this time and time again. So it's really an awareness problem, an education problem. This is a very nascent market, this concept of online capital formation and investing for real estate. So it's really telling developers and investors what this is, why it's the future, how it's going to help them do business better or generate returns that they can't get elsewhere. And it's funny, when I first started this company in late 2013, and I would go to a conference or a panel and talk about this concept of crowdfunding for real estate, as we called it back then, people in the room would scratch their head and not know what the heck I was talking about, or just say, well, that's never going to work. And, fast forward 3.5 years later, and it's actually gotten, even though it's not being used by every investor and developer, meaning there's still a ton of latent demand and supply, at least a lot of people know about it. At least a lot of people know about it now, and they've heard about it. And so I think it's starting to change, and developers don't want to get left behind. They want to know that they're part of the future, and so do investors. But there's still this huge, what I call crossing the chasm, moving from the early adopters to the majority of investors and developers, and that's just going to take education. It's going to take brand marketing. It's going to take people just knowing about RealtyShares. But once they use us, what's exciting is they're hooked and they love the value that we bring to their day to day.
Well, look, I'm a real estate guy, like I told you earlier on, and I want to give up with the bricks and mortar and just make an investment through RealtyShares. I'll tell you that already by the end of our conversation. So you've done a good job with me anyway. Hey, Nav, thank you very much indeed for your time. Yeah, thanks for your time.
Thanks so much. It was a pleasure. Thanks so much for having me.
That was Nav Athwal, founder and CEO of RealtyShares. Interesting website, nreforum.org/RealtyShares for the show notes to this episode. I've also put together a free summary for you of the Jobs Act and its various regulations. It covers the basic background, and you can get that on the main page of the nreforum.org website or at nreforum.org/primer. Coming up in the next few weeks and months, the National Real Estate Forum.org, nreforum.org, will cover crowdfunding real estate from all perspectives. My next guest is Rod Turner of Manhattan Street Capital. Rod knows just about everything there is to know about Regulation A+ offerings, the so-called mini IPO for real estate. And his insights will show you how you can raise capital and at the same time give your investors an immediate opportunity to trade their shares. If you want to become a world expert in real estate crowdfunding, go to the National Real Estate Forum.org website, nreforum.org, subscribe on whatever platform you use to listen to podcasts, and tune in. Thank you again for listening, and thank you Nav Athwal of RealtyShares for sharing your time with me today. Until next time, this is Dr. Adam Gower,